Hi everyone, thank you so much for joining us this afternoon. Before we start, we're going to run through a few quick housekeeping items. Instead of showing you where the fire escape is, we'll be showing you how to ask a question during the Q&A section and also just running through the virtual flow of events. So today I am joined by three esteemed professionals. Starting with the ladies first, we have Mrs. Tonya Nita Elliott, who is the AVP of Personal Financial Planning at Sterling Asset Management. We also have Mr. Dwayne Neal, who holds the same position at Sterling. And last but certainly not least, we have Mr. Eugene Stanley, who is the Vice President of Foreign Exchange and Trading at Sterling. Now, why are we here? Long before the first COVID-19 case came to Jamaica, we have been on the phone with our clients since February 2020, talking to them about the pandemic-induced volatility that they would have been observing in their portfolios from as early as February. Now, we have been on the phone with them trying to figure out how to help them position their portfolios to weather this uncertainty. In fact, earlier this year, we held an event called The 3 Biggest Mistakes Investors Were Making Amidst COVID-19. Now, as we learn more about life and the economy amidst COVID-19, which appears here to stay, we get more and more questions from investors. People are asking how they should be managing and allocating their portfolios at this time. For a long time, investors were sitting on the sidelines waiting for the volatility to ride itself out. However, one thing we have learned is that uncertainty is here to stay. And in fact, both Dwayne and Tonya have observed that many investors were asking the same questions. In fact, the answers to these questions would be very helpful to a broad group of people. So we arrived at this event here today, and today we're trying to address the most frequently asked questions about investing during the pandemic. I'll be asking Tonya, Dwayne, and Eugene a series of questions that represent submissions from investors and also just general excellent questions we've gotten from our sophisticated investor base. We'll spend about 35 minutes grilling our panelists, and then we'll open a question and answer segment that all attendees will be able to submit their questions. Please make sure that you type your question into the Q&A section on your screen and make sure that all panelists are selected. Now, Eugene, we're going to start with you because for sure, the most controversial topic and often the most frequently asked question we have been getting relates to the exchange rate. What happened with the exchange rate in 2020, Eugene?
Thank you, Marian, and good afternoon to all our viewers and listeners. Okay, so 2020 has been a roller coaster year for the Jamaican dollar so far, largely in part due to the impact that COVID-19 has had on our foreign exchange inflows, particularly through tourism. There's been a significant shortfall in tourism receipts as the country would have locked down somewhere within March and April to combat the spread of the virus. But it wasn't just in Jamaica. I mean, that was something that took place on the global stage, lockdown restrictions to prevent the spread of the disease. Now, we saw some improvement in remittance inflows, but unfortunately, it was insufficient to offset the declines from tourism. So long and short, demand picked up and supply fell off. So the ongoing devaluation of the Jamaican dollar intensified in 2020. I'll just give you an example. For the year so far, this was as at last week Friday, the devaluation rate was at 11%. Last year, this time, we were looking at a devaluation of 6.5%. Although we did see towards the end of last year that there were significant gains for the Jamaican dollar and the currency end up with a decent devaluation rate of 3.8%. I don't anticipate we're going to see that being repeated this year. And the reasons for that are, one that I just mentioned about the significant shortfall in foreign exchange earnings. But secondly, the ability of the Bank of Jamaica to continue to aggressively intervene in the foreign exchange market has and continues to be weakened by a declining net international level of reserves. As a matter of fact, for the year so far, the NIR has fallen by 13%. That's roughly
Wow.
400 million US dollars. So with those two factors at hand, I anticipate that the devaluation rate will be significantly higher than it was in 2019.
Well, that's interesting, Eugene. Can you give us a bit of a historical context? You mentioned the 11%. It especially helped when we compared to the last year of 3.8. What's the historical trend that you would want investors to know?
Okay. Well, since full liberalization of the foreign exchange market in 1991, that's a 25-year period, on every year, with the exception of 3 years, namely in 1996, when the Jamaican dollar gained 12%, in 2010 when it gained 4.2%, and more recently in 2017 when it gained 2.7%. So for 26 out of those 29 years, the Jamaican dollar has devalued against the US dollar. Now, I mean, that's a long track record, So if you were to follow the trend, I anticipate that the devaluation will continue. Now, of note, however, over that period is that the pace of declines have actually fallen.
Okay.
So for instance, over the last 20 years, the average annual devaluation rate was 12%. Actually 6.4%, correction. Over the last 10 years, it was 4.7%, and over the last 5 years, it was 4.3%. So, I mean, we've seen a significant reduction in the pace of decline as the Jamaican dollar economy improves with a lot more foreign exchange inflows coming in and so forth. But the truth of the matter is, I mean, our imports continue to exceed our exports, and so the demand for foreign exchange will continue to outpace the supply of foreign exchange, which will continue to weigh on the strength of the Jamaican dollar going forward.
That's great. I'm glad you bring up the imports exceeding the exports so that we all have an objective basis for determining the outlook. There's one more thing that you frequently speak about, Eugene, which is the inflation rate differential. Can you tell us what that means? We hear it bandied about a bit.
Excellent point, Marian. So for exchange rate parity to be maintained, what it usually suggests is that if you're comparing the currencies between two countries, and a country has a higher inflation rate than another country, then you would expect the currency of the country with a high inflation rate to devalue against the other currency, against the other country's currency. So for instance, when you look at the value of the Jamaican dollar versus the US dollar, inflation in US is targeted at 2%. Here in Jamaica, our targeted inflation rate is between 4 to 6%. So on average, on an annual basis, you should expect the Jamaican dollar to devalue somewhere between 2 to 4%. That's on a yearly basis. It doesn't mean that will happen every year, because I've mentioned there have been the odd years when we actually saw an appreciation, and there have been years when the devaluation rate has been significantly higher than the norm. But over time, it should gravitate towards that. As a matter of fact, we actually saw that over the last 5 years. As I mentioned, the average devaluation rate over the last 5 years has been 4.3%. And if you look at the inflation differential between the US and Jamaica, at the high end, it's 4%. So we're seeing that trend evolving.
That's really interesting, Eugene. I'm sure it's no coincidence that the Bank of Jamaica has moved an inflation rate targeting regime as a result. Or this could be the result of that shift.
It could be. That's an excellent observation, indeed.
So my last question for you, Eugene, on the exchange rate, because of course, as we know, it is a popular topic. What are the short-term trends that you have noticed? Because you've given us the reasons for the long-term. What are the short-term trends that you've noticed, especially since the introduction of the Bank of Jamaica's Bfixit mechanism?
Okay. All right. And just for persons who don't know what the Bfixit mechanism is, Bfixit really stands for Bank of Jamaica Foreign Exchange Intervention Trading Tool. And it basically replaces the system that the BOJ have before in terms of how it intervened into the foreign exchange market. And I guess one of the big things with the Bfixit module is that the Bank of Jamaica wants to see a two-way moving currency, and Bfixit is supposed to facilitate that occurrence. Now, since Bfixit in 2017, I've actually noticed 4 patterns emerging. One, there's been a greater incidence of monthly appreciation of the Jamaican dollar. 2, sharp depreciations are followed by a period also of sharp appreciations. And in addition to that, and then 3, at the start of every quarter, you can expect that there's going to be a significant devaluation of the Jamaican dollar. And as the quarter wears on, an appreciation usually takes place. In some quarters, the appreciation is greater than the depreciation, and you end up with an appreciation for the quarter. Additionally, in the last month of each quarter, the Jamaican dollar has actually gained in value, with the exception of 2 quarters in 2017 and 1 quarter in 2018. Wow. So you can expect to see an appreciation of the Jamaican dollar every March, June, September, and December, basically. Right? And then the final observation is that the Jamaican dollar tends to perform best in the last quarter of every year as foreign exchange supplies increased and demand for foreign exchange tapers off.
Well, that information must be really helpful to people who are trying to plan their liquidity and working capital
really does.
Throughout the year. And I'm glad you shared that information with us, Eugene. Thanks. That's definitely a point of interest for people. Now, Tony Ann, as we are speaking a bit about Jamaican dollars, one of the trends that you have mentioned is that quite a few people have been liquidating their real estate and trying to invest that money, especially since the rental market has been soft, and that has been compounded by COVID-19. Now, an investor is asking, I have just sold a piece of real estate. What do I do with the proceeds?
Okay, thank you, Marianne, and good afternoon, everyone. The advice that I would give to somebody who has sold a piece of property and they're trying to decide what to do with it would really depend on what that property was being used for, what that person's circumstances are, and what their objectives are. So, for example, somebody who sold a rental property and they were reliant on that rental income and need to replace it, or if you're dealing with a retiree and they're in need of retirement income, those people would obviously need to put the money in something that's going to give them income. And I would recommend that they invest that money in US dollar bonds. The reason is that bonds work in the same way as real estate, in that they offer steady, predictable income in the form of interest instead of rent, but without the hassle. With bonds, you just buy the bond, you enjoy the interest, and that's it. But with real estate, you have the hassle of dealing with tenant complaints, you have to deal with repairs, you have to deal with ongoing expenses such as property tax, insurance, and other things associated with maintaining a property. With a bond, you avoid all of that. And on top of that, bonds offer certain advantages over real estate. One such advantage is the fact that if you need emergency cash, you can actually sell your bonds very quickly. Within 2 to 3 days, you can have that cash in hand. That's not possible with real estate. Another advantage that bonds offer over real estate is the fact that you can secure consistent income for a longer period of time by, for example, buying a long-dated bond. So you could buy a 10-year bond, and by doing that, you actually secure your income for a 10-year period. Whereas with a property, you would be unlikely to find a tenant who is going to commit to a very long-term lease. And so you may end up with periods of time where you're in between tenants, and so your property is just sitting there not earning any income, which isn't ideal. Another thing that people don't realize about bonds is that they actually offer similar and oftentimes higher returns than real estate. And I'll actually just give you an example of that. I recently met with a retired couple, and they had sold their family home and moved into a small apartment, and they had Jamaican $25 million, and they were trying to figure out what to do with that $25 million in order to earn some retirement income. I was shocked when they said that they were thinking of buying a rental property. To paint a picture for you, the reason why I was shocked is that this couple was in their 80s. They're not mobile in that neither of them drive. And so the running up and down that might be associated with being a property owner would have been a challenge for them. And on top of that, their children, grandchildren don't even live in Jamaica, so it's not even like they could pass off that responsibility to somebody else. So kudos to the real estate agent, because she also was actually discouraging them from being landlords at their age and stage, and had actually suggested that they invest the money, which is how they ended up talking to me. I was able to show them that if they take that Jamaican $25 million and convert it to US dollars and invest it in bonds, the sample portfolio that I put together for them would have earned them just a little over US 11,000 per year, which at the time, based on the exchange rate, would have been about Jamaican 140,000 per month. They certainly wouldn't have been able to get that kind of rent on a $25 million property. And you actually have to bear in mind that they wouldn't have actually had $25 million to spend on the property, because they would have had to factor in closing costs. So their price point would have actually been lower. So I think they would have been challenged not only to find a property within that price range, but also one that would offer them that kind of rent. So
that's a very good point, Tony, and no need to remind young people about the exorbitant cost of property. It's definitely harder and harder to acquire property. The price point keeps rising. So, Tony, and I have another question. I want zero risk, no risk at all. I'm very risk averse. What can I buy?
If I had $1 for every time somebody asked me that question, I would be rich. I actually want to rephrase that question, because there's actually no such thing as no risk. Even putting your money in a bank account is going to involve some element of risk. And let's not even talk about putting your money under a mattress, which many people have been threatening to do these days because of their frustration with banks. So instead, let us look at this question from the point of view of somebody looking for low-risk options. If you're a conservative investor and you're looking for low-risk options, you can ask your financial institution about things such as repurchase agreements, more popularly known as repos. You can ask about promissory notes or other fixed deposit type investments. What you should not be asking about is stocks. I'm always shocked when people tell me that they are low-risk investors, and in the very next breath, they ask me about stocks. And what is even more interesting is a lot of times when those people ask about stocks, I say, well, if you're willing to discuss stocks, let us think about investing in bonds instead. And almost 100% of the time, people's response is, no, bonds are too risky, I'm not interested in bonds, which is interesting to me because of the fact that bonds as an asset class are actually lower risk than stocks as an asset class. But I think it's just a case of familiarity. You know, people are more familiar with the idea of stocks and investing in the stock market. I mean, I can remember even as a child, I used to know what stocks were. And hopefully I'm not aging myself, but stocks, you know, shares used to be in paper form. And it was not uncommon for a family member to buy a share certificate and give you as a present. So I always knew what stocks were. But I didn't know what bonds were until maybe I was in universities, maybe the first time I actually heard about bonds. And I certainly didn't know anybody that had invested in bonds until I was probably working in banking. So I think it's just that people are more familiar and that they find bonds mysterious and scary and intimidating because they don't know how bonds work. But I digress. We're actually talking about low-risk options. What I wanted to point out is that very often people say that they're low risk. But when you start discussing the kind of rates associated with low risk, they're actually very surprised. And that's because a lot of people are not cognizant of the fact that when you invest, you're actually compensated for the amount of risk that you're willing to take. So the rule of thumb is actually low risk, low returns, high risk, high returns. So if you're going to be investing in a low risk product, you need to be aware and you need to accept the fact that you're going to be getting lower returns than if you invested in a higher risk product. To put it in context for you, in the current low interest rate environment, if you invest in a low risk product now, you can probably expect to get anywhere between maybe 2 to 4%, and that's even on the high end of low risk. For medium risk, you can probably expect to get about 6%, and for high risk, maybe about 8%. And the reason why it's important for people to understand the type of return associated with specific risk levels is so that you can be a more intelligent investor. If you go to a financial institution, you tell them that you want a low-risk product and they're offering you something that pays 8%, you actually need to ask questions because that is not a low-risk product. So to recap, if you're looking for low-risk investments, you need to be asking about repurchase agreements, promissory notes, and other fixed deposit type investments, and you should not be asking about stocks.
100%, Tony, and we can definitely relate to that struggle. As we're the ones that have to find the assets and explain the risks. So going to that point about low risk, medium risk, high risk, Tony, and there's been a lot of volatility in the market. One day the prices are up, one day prices are down, one day yields are high, one day yields are low. When is it safe to re-enter the market?
For me personally, I think that's probably hands down the question that I've been getting the most. And that's because of course, the uncertainty to do with COVID and with the US elections coming up. But this is a time when we all wish that we had a crystal ball and we knew what was going to happen. But the truth is, even the best researchers and analysts don't know. They can't predict the market with 100% accuracy. I'm sure that at the beginning of the year, when the markets were booming, everybody thought that was a great time to enter the market. And then, of course, COVID happened. None of us could have predicted that, and we all know what happened from there. So there is a popular investment philosophy that I actually share with people when we're discussing this whole idea of whether now is a good time to enter the market. And that philosophy is that it is time in the market that is important, not timing the market. So basically what that is saying is that it's less important knowing when to invest and more important how long you stay invested for. So rather than trying to predict the highs and lows and trying to figure out when is the right and wrong time to enter the market, what people should be doing now actually is positioning themselves for this volatility. And the best way to position yourself for volatility and protect yourself against volatility is to have a long-term plan, a well-diversified portfolio, and just stay the course. But of course, people are still going to ask, is now a right time or the wrong time to enter the market? So if you're fearful about entering the market at the wrong time, there are actually strategies that you can use to alleviate that fear. One such strategy is dollar cost averaging. And basically what that is that instead of investing all your money right now as a lump sum, you actually can invest your money in increments over time. And what that will achieve is that if you buy an asset now and the price falls after you buy it, you're able to buy more of that asset at a cheaper price, therefore averaging down your purchase cost. I know that Dwayne is a big proponent of dollar cost averaging, so I don't know if he has anything here that he would like to add.
Thanks, Tony, and good evening, listeners. Okay, I do agree with Tony that in these volatile times, one way of mitigating losses and actually positioning yourself for future gains is dollar cost averaging. The idea of dollar cost averaging is that you want to buy periodically in an attempt to have the lowest average cost per unit. If you already own assets, let's say it could be stocks, it could be bonds, because this does work across different asset classes. You can, if the prices have fallen, you can look to buy additional units at lower prices. This will in turn reduce your average cost per unit. When markets normalize and prices begin to rebound, your lower average cost will put you into a profit position much more quickly. So this is one of those strategies that can be used to help during this time.
Thank you very much, Dwayne. Before we actually move on from this idea of whether now is a good time to enter the market or not, there's one last thing that I wanted to point out that may come as a surprise to people who don't know how bonds work. The truth is, if you buy a bond and hold it to maturity, it actually doesn't matter if the price of that bond falls after you've bought it. The reason is that bonds pay a fixed rate of interest for a predetermined period of time, irrespective of how high or how low the price of that bond goes after you buy it. So if you're employing a buy and hold strategy with bonds, you actually don't need to worry about timing the market. When you buy a bond, you lock in your yield and you know exactly upfront what you're going to be getting. So if you're comfortable with the return that you're getting on a bond right now at its current price, that means that now is the right time to buy that bond.
Wow, that's a perfect answer, Tony and Dwayne. Thank you. It's such a fundamental concept, and it does change the way we look at the market, because people are afraid to buy in case the price goes down. But if I'm understanding you correctly, Tony, and you're saying that with a bond, your return is locked in until maturity. And that's very fundamental. And as Dwayne mentioned, even if you're holding a mutual fund or a unit trust, if the price goes down, you can simply buy more. And this is relevant for people that hold assets over a longer time horizon. I loved your quote, Tony, Ann, about time in the market rather than trying to time ing the market. So I just want to remind our listeners that you can submit questions via the Q&A feature on the webinar. Please just make sure that all panelists is selected. You can submit your questions as early as now. We have a few submitted questions before we get to the Q&A segment, but please submit your questions at any time. So we're going to shift gears briefly. Dwayne, I'd like for you to tell us what, how do you think that the US elections will affect markets? US politics seems to be all over social media lately.
It has been the topic that a lot of people have been asking about. A lot of people, especially with the current candidates, people tend to be very, questioning, what will the outcome cause, what will be the negatives, what will be the positives. For just generally when there's a government election, what you find is the uncertainty of the outcome can lead to market volatility. Persons will begin to speculate, what the outcome will be, how the outcome will affect their investments. The policies set forward by each candidate will have effect on different industries, different countries. So for persons having investments in countries or industries that they think can be affected by a specific outcome, they will most times try to be proactive. If they foresee a negative impact on their investment, then persons will try to get out of the investment as quickly as possible. This can cause a run on the investment, causing prices to fall very quickly and even fall below realistic levels. If persons see that investments will be positively impacted, then you'll have lots of persons trying to get in, more buyers than sellers, prices will go up. You also have the problem here that prices now may become maybe higher than where the true value is for these investments. So it is critical that persons monitor their investments, they do periodic valuations of the investments, and make sure that the assets are not overvalued or undervalued. If they are, then need to take action. Mm-hmm. So persons might look to sell assets during this time. You can buy back these assets in the future when markets settle. Prices may come back down, you take your profits, you go in and you buy more. So it does present opportunities for you to buy, and it does present selling opportunities.
Yes. Dwayne, your youth is reflected in the activism of your investment strategies. That sounds like a lot, but from what I'm getting, you're suggesting that it's a good idea to keep liquidity on hand and certainly take profits where you can and buy back lower when you can, when the opportunities present themselves. And I think to your point, and to a point Tony Ann made earlier, it seems that uncertainty is now a constant in the environment. And rather than sitting on the sidelines, we've got to invest amidst this uncertainty, not wait for it to ebb, basically. Now, shifting gears a bit from the US market to the Jamaican market. And this question is also geared towards people who are a bit younger and are still in the process of contributing to a Jamaican dollar pension plan. For instance, I know certainly that each month, maybe 10, 15, 20% of people's paycheck goes into a pension plan that is managed by a big insurance company or a big asset management company. And I don't know about you, but I certainly have never seen any documentation or any information about those returns. And this is something that goes out of our paycheck every month and over our whole working lives, 20, 30, 40 years. And I certainly don't know how much money I will get when I retire from that pension plan. So I think also a bit concerning is in the news lately, there has been some information saying that these pension plans have to invest the majority of their money in Jamaican dollars. So they can't invest heavily in US dollars. They can't invest heavily in equities, which are typically asset classes that people invest in to grow your income over the long term. So tell me something, Dwayne. I no longer want to contribute to a Jamaican dollar low growth pension plan. What are my options as a young person to save for retirement?
Okay, so for looking down the line 10, 20, 30 years to retirement, it makes a lot of sense for us to follow some of the principles of a pension plan in that you want to make periodic investments. So you want to commit to investing whether monthly, quarterly, even annually, but you want to do that on a consistent basis. Reason being, you want to be able to take advantage. Opportunities occur daily in the markets. So if you have that cash being pumped into your investment periodically, you can take advantage of these opportunities. The non-traditional methods of investing for pension, I would suggest one, looking at global bonds. Reason being, you're now exposed to US dollar investments. You're not limited, as the pension plans are, to only being able to invest a certain amount in US dollars. You also are able to trade in and out of these investments. So that over the long term, you can take capital gains. A lot of people ignore the fact that bond prices fluctuate. Bonds don't only pay you your interest, your coupon payments. Bonds will also fluctuate in price, allowing for capital appreciation. So you can take gains on some of these bonds. If prices fall, like I said before, you can buy back into some of these bonds. So that is one option for persons who have the ability and the time to actively manage their own pension over the next however many years. The second non-traditional method that I would emphasize is actually mutual funds. The mutual fund gives you, a fixed income based mutual fund. Reason being, you get the benefits of fixed income instruments, the benefits of bonds, without having to be the person to make those decisions, to decide when to buy, when to sell. You allow a professional fund manager to do all of this for you, and you can sit back, look at what is being done. It's very transparent. You can see what is being done. You understand how your money is being invested, and you can see those benefits going forward.
That's a good point, Dwayne. I like, one thing I really like about the mutual funds is that you don't have to be Einstein to figure it out. Each week there's a price and you can quickly calculate the value of your units, so you know if the asset manager is doing a good job, a bad job, and the information is always there. It's actually part of the regulation that this information is published regularly.
Correct.
So it's a super easy to track investment, and certainly, as you say, for busy young people, it's a great alternative to a pension plan. Now, going to the slightly older segment of the market, Dwayne, we spoke about how to save for retirement as a young person. For an older person that is actually looking to retire, what are the most serious trends that are affecting them right now?
Okay, so for currently, I would say the top two trends would be one, inflation, and two, devaluation. Reason being, inflation affects your purchasing power. So what you're able to buy today for $1, you might not be able to buy in 10 years' time for $1. Typically, you're not able to buy as much. So your consumption is then less if you are earning or if you have the same pool of funds that you had when you started investing. So it is important for you to invest so that you are earning a rate that is higher than the rate of inflation. Eugene had said inflation was at about between 4 and 6%. Yeah. So typically, for you to be able to consume the same amount of goods and services when you get to retirement, it's important that you are now investing at least that 6% in order to be outpacing inflation. The second biggest trend, I would say, is devaluation. And devaluation over time has been, the last 5 years, you're looking at devaluation of the Jamaican versus the US dollar at a rate of about 4.3%. If you're to now compound inflation and devaluation, then to be able to consume the same amount of goods and services when you get to retirement, you need to be earning at least 10% on a Jamaican dollar investment. which in the current times, a 10% return is actually going, like Tony said, it's high risk. So.
Almost non-existent.
Right. So if you can mitigate the devaluation by converting to US dollars, investing in US dollars, then essentially you're now looking at the only effect that's really affecting you like that is inflation. So you could do a US dollar investment at 6%, which we said earlier. It's medium risk in the current marketplace. So you can take on less risk investing in a US dollar instrument, or you can keep your funds in Jamaican dollars and try and get 10%.
Well, so Dwayne, as Tony said, I hope I'm not aging myself here, but I guess would an example be that when I was in school, a patty cost $20 and now it costs a lot more than $20?
That's exactly.
So if I would have had, my $20 would have had to be worth at least $150 today for me to be able to afford one patty with the same lunch money.
Yes.
That is quite stressful. So basically you're telling me, Dwayne, that people at retirement now need to have more money than they did before.
Yes.
And also, you're telling me also in a way that people have to take more risk.
They do.
Because as Eugene said, interest rates are quite low. As Tony mentioned, low risk investments are yielding anywhere from 2 to 3%. So quite often people who come into our office at retirement say they want low risk, but low risk investments actually cannot support them in their retirement. So this is this is kind of disturbing, but I think the solutions that you mentioned were higher growth products like mutual funds, keeping your money in US dollars, and I think those are really helpful suggestions. What I would like to do is turn to Eugene for a minute, because a lot of what you were describing, Dwayne, in terms of inflation, devaluation, relate to some of what Eugene was saying at the start. So maybe, Eugene, you could finish us off by telling us what can we expect to see? What is your outlook for the inflation, for interest rate, and how should investors position themselves?
Thank you, Marian. All right, so as it relates to interest rates globally, interest rates are expected to remain low for the foreseeable future. Major central banks have reduced interest rates to record low levels to mitigate the impact of COVID on their economies. So basically, monetary stimulus being injected. In addition to that, inflation is low and is expected to remain low globally. Again, major developed economies have had difficulty even trying to boost inflation to normal levels. And with the onset of COVID, that's going to be even more challenging for them to achieve. All right, so low interest rate, low inflation, that will continue to support global fixed income securities. So bonds will continue to perform well. As it relates to devaluation and Jamaican dollar investing, I'd mentioned the trend in the exchange rate over time. That trend is expected to continue. The Jamaican dollar will continue to value against the US dollar. But also, Dwayne mentioned the minimum return that an investor will need if they invest in Jamaican dollars to stay ahead of the game, meaning beating inflation and devaluation. They need a minimum of 10% on a Jamaican dollar investment. In this environment, that is a very difficult task to achieve. Case in point, the government of Jamaica recently issued some instrument. The longest instrument would have been for 14 years, and the average yield on that instrument is a modest 5%.
Wow.
So we're about 5% on Jamaican dollars, right? So, of course, if you were to take out devaluation at 4%, then we're left with 1%. Yeah. And then with inflation, then your returns are negative, plus withholding tax. So you'll have a lot of catching up to do. Luckily, as my colleagues had mentioned, you can just simply invest in US dollar assets, preferably bonds, which will preserve your wealth over time and allow you to also grow your wealth over time. Interestingly also too, you can get, even though interest rates are low, you can get better returns on US dollar investments now than you currently do on Jamaican dollars. So it just seems like a win-win situation, staying invested in US dollars.
That's a really good point, Eugene. I'm really glad you brought up the GOJ instruments because it's a very fresh reminder of what Jamaican dollar fixed income is yielding. And I think you shared with us even earlier today what the Jamaica stock market had done year to date. Can you remind us of that figure?
So year to date,
Yes.
the Jamaican stock market has fallen 27.2%, if you want to be exact.
Okay.
Now, one of the things which would have boosted the Jamaican equity markets over the past 5 years would have been the fact that the government of Jamaica, who historically would have been an active player in the capital market, removing Jamaican dollars from the system, call it crowding out, changed that, and the term that they now use is crowding in, meaning that they're putting more liquidity into the system than they're taking out. Right. So that have aided the performance of the Jamaican equities market over time, and added to that, interest rates locally have also been low. But now with COVID and the government likely, to be going to the market more often than they would want, I mean, just to keep the coffers going as earnings fall off and tax receipts fall, then that is bound to have an impact on the equities market. But certainly for the rest of this year and maybe at least until the middle of next year.
That's an excellent point, Eugene. A reduction in liquidity is certainly removing a catalyst from the performance of the Jamaica Stock Exchange. And actually, at our last investor briefing right here, Keith Collister mentioned something that I thought was interesting, that the Jamaican stock market seems to have very short periods of very attractive growth, which we've just seen, followed by some periods of stagnation. So certainly, we have some time to evaluate the value investments on the stock exchange. We may have a few years to do some research there, but we want to remain invested in US dollars in the interim. So we're taking a few questions from our audience. And one question, is there an insurance scheme in place for the protection of these types of investments in Jamaica, or are they solely risk-based? I will, I guess, take a stab at that question, and someone can save me if I'm going off in a wrong direction, but I believe that there is no insurance scheme for these for mutual funds or global US dollar bonds or equities. Any investment that you make, I believe, you stand the whole risk of it. There is, I believe, the Jamaica Deposit Insurance Corporation does protect a certain amount of your savings in the bank.
That's correct.
And I believe that the government may have just increased it slightly.
1.2.
I'm not sure it has gone. I know it used to be at 600,000.
600,000.
Right.
I'm not sure it has gone now.
Right. So there's no, which is why it's really important to get an investment advisor that you trust and is knowledgeable. Our tagline is intelligent investing, because certainly when you invest, you bear the full brunt of the risk. What if there is a default on the bonds? What will happen? I guess which of my panelists would love to take that one?
Let me take a stab at that one, Mary. Well, unfortunately, from time to time, issuers will default on their bond, meaning that they fail to either A, pay the proceeds at maturity, or are unable to pay periodic coupon payments as they fall due. So invariably, what happens if a bond defaults, it doesn't necessarily mean that you will lose all of your investment. What usually happens if the bond defaults on principal, it usually, you usually refer to what is called a recovery value of the bond, which basically means that once the liquidation of that company or issuer takes place, a certain portion of funds are left back for bondholders. And one gauge of a possible recovery value on a bond could be the price at which the bond is trading. So, for instance, if a bond is defaulted and you'd probably see it trading like 20 cents on the dollar, then the expectation is that the recovery value will be 20 cents. But in reality, and oftentimes the recovery value is much more than where the market suggests that the bond should be trading. As it relates to the principal on the bond, if an issuer defaults on the principal, well, for one coupon payment period, then they have until the next coupon payment period to make good on the coupon for that period, but also for any missed coupon payment. In the event that they're unable to do that going forward, then the holders of the bond can petition the issuer to wind up the operations, and then the recovery value comes into being.
Right. Oh.
But actually, that's one of the reasons why, when I mentioned earlier that bonds as a general asset class are actually considered lower risk than stocks, is because in that same situation where a company were to go bankrupt and not be able to meet their obligations, a bondholder actually has priority over a shareholder in terms of who gets paid back first. So that's one of the reasons, again, why bonds generally are lower risk than stocks.
Excellent point.
But also, what we're forgetting is that if you have an advisor or you have a broker who is proactive and will do the research, give you the information, they should be able to pick up beforehand, is there a problem with the company? It might not be in every situation, because sometimes these things escalate really quickly, but having the information, tracking the companies, knowing what's going on with the company is important, because you definitely can pick up trends. You will see happenings in the market, in their financials, to be able to question, is there something down the line? Will there be a negative effect? How will this affect my interest payments or my principal payment?
That's true, Dwayne. There are usually signs in advance. I mean, as you said, bonds, it doesn't necessarily happen overnight. And that's another reason why it's important for people to actually choose good quality bonds. And as Marion said, making sure that you have an advisor that's guiding you appropriately. And not choosing a bond because it's issued by a name that you're familiar with. You know, really understanding that you're lending, when you buy a bond, you're lending money to the issuer. So you want to be lending your money to somebody who can pay you back, basically.
It's also important to pay attention to the credit rating of the bonds. While it doesn't necessarily guarantee that the issuer will repay their debt, but at least it gives an idea of the likelihood of such repayment taking place. So poorly rated bond, the expectation is that they are more likely to run into problems than a bond which has a higher credit rating. So it's also important that you pay attention to the credit rating of a bond.
That was awesome, guys. Thank you. That was a lot of really helpful information. And there are articles on our website, sterling.com.jm, that talk about the credit ratings, as Eugene mentioned, that explain what happens when an issuer defaults and how to spot it early. I know our wealth advisors are very experienced at taking people out of bonds when conditions change, when oil prices dropped a few years ago. I know some people would have sold, not necessarily at losses too. It's just sometimes you exit the position early. And for reasons like that, Sterling would have avoided, for instance, selling some Digicel bonds to certain people that had a lower risk profile, even though, as Tony Ann said, it's a very familiar name. We recognize that the risk was not appropriate for some clients, certainly. So one more question that we've received from our audience. With a portfolio of 200,000 US, what percentage would you recommend investing in medium risk US dollar investments? Would anyone like to take that one?
Sure. Okay, so each investor has a different profile. So in order to answer that question, I would have to say it's dependent on the individual. So what we will do is we will assess your risk appetite. We will determine, are you looking for growth? Are you looking for income? These are questions that have to be answered before we can tell you how to allocate funds in your portfolio.
Okay, that's a great point, Dwayne. And I think that you guys must suffer a lot from that, because people constantly ask you, is this good? Is this bad? And, you're saying basically it depends, or how much do I buy of this, how much do I buy of that? And a thorough investment analysis, risk profile is necessary. Right. Sorry. Okay. Someone is asking if the price of the bond is really important. That's an interesting question.
Yeah, it is an interesting question, because the price of the bond is what you're going to pay for it. So I'd like to think that is important. But more importantly, you also want to pay attention to the yield that you're gonna get on the bond. especially if you're going to be holding that bond to maturity. As Tony and said earlier, the important thing for long-term investors is the return that they're going to be holding, the return they're going to be getting until the bond actually matures. So, you know, you don't have to try to time the market. It's more time spent in the market, you know, to achieve your investment objective. You know, so some investors are scared of buying bonds, which they consider to be very pricey. Maybe say a bond costing $120, but it probably still have a very good return of say 7%, compared to a bond that's probably trading at a discount and has a very low yield of maybe 4%. You know, so it's more the yield that's important, and the price is just what you're going to be paid to get that particular yield.
That's a great point. Tony, do you have anything to add, or did Eugene do it perfectly?
I think Eugene did it perfectly, because, you know, when you buy a bond at a particular price, as we said, you're locking in your yield. And so at the end of the day, for you to compare bonds, because, you know, bonds will have different coupons, different tenors. So in order to compare apples to apples, what you really need to look at the end of the day is the yield and not necessarily the price of that bond.
That's a good point.
One final point, Marion. Also, it's also important to note that, I mean, regardless of how high the price of the bond is today, chances are the price of that one can go even higher. And more so in this environment of low interest rate, which I mentioned before, will continue to support bonds. So the lower interest rates are, the higher bond prices will be.
Certainly. That's a good point. And we have lots of articles on our website under the blog section that actually explain how bonds are priced and how the yield is calculated, so that investors can understand how they earn a return, because that's very important as well. So our last question actually relates to something Tony Ann spoke a bit about earlier, which was real estate versus US dollar investments. And particularly, someone is asking, how do we view investing in real estate versus investing in US dollar investments? And possibly if people came in a little later, that was one of our first questions. So Tony Ann, maybe I guess could you just give us a 2-minute overview of how someone would contemplate, how someone would view investing in real estate versus investing in US dollar investments such as bonds?
Okay, well, yes. So just to recap, in terms of real estate, you know, people have been investing in real estate and enjoying it, but there will be times where, especially now when the rental market, as you mentioned before, the rental market is soft. So people may be exiting real estate. And of course, real estate is typically priced in Jamaican. And as we've said over and over here this evening, it's probably better that you invest in US dollars. So I would say that you would invest in US instead of investing in real estate. But it really depends on the market. It depends on the person's situation at the time. So it's kind of hard to just answer it, you know, broad brush.
For sure. And I mean, sorry to refer again to the website, but there definitely are blogs on real estate versus US dollar investments and the different scenarios. Maybe this last one for Dwayne, maybe. We spoke about young people contributing to, you know, possibly doing global US dollar bonds or mutual funds. But could you actually tell us what type of investment that you would recommend to someone who is actually maybe over 40 and has not necessarily been investing as they should and needs to build up some assets quickly? Because one thing we've been asked is if by those people, for instance, is if they should start contributing to a pension at that age. So I guess what this person may really be asking is, you know, does contributing to a pension or an approved retirement scheme, an individual retirement arrangement, some of these popular schemes that are peddled now, does it make sense for someone over 40 to start contributing to one of those schemes as a way to build up a nest egg for retirement?
Well, before getting into the answer, the first thing a lot of us need to look at is your retirement planning should be twofold. Planning to retirement and planning for when you get to retirement. So you're going to have two totally different strategies here. Planning to retirement, especially for somebody who is already over 40, you need a more aggressive investment plan. So in this case, definitely you're going to go for the US dollar investments. And I would recommend something that gives you a higher than normal rate of return, but it is being managed by a professional. So, for example, the mutual fund, again, it allows the professional to make those decisions. We individually, we may not be able to achieve some of these higher than normal returns. So have that managed by the professional, so that when you get to the point of retirement, your pool of funds should be greater than if you were to put it in a pension plan now and leave it for the next 20, 25 years.
Okay, that's helpful, because I think I certainly have been asked a few times if it makes sense to start contributing at that stage, but definitely, as you mentioned, a more prudent approach would certainly be to go with a pooled fund, a mutual fund, US dollar investments, high growth. So that is actually our final question here today. And we would like to thank everyone for listening in. We know your time is very valuable. We hope that this will be one of many other future information sessions. Please give us your feedback at info@sterlingasset.net.jm so we can continue to make these sessions helpful and relevant. Please also check our website at sterling.com.jm for the key takeaways from this event, as well as helpful short blogs that will also explain some key terms about investing, and as Tony-Ann said, help you become a more intelligent investor. And also sign up for our newsletter, where we send out some of Eugene's awesome market data every week, letting you know what's going on in the market in bullet point table style, really easy to read. We include an investment tip as well. So thank you guys for joining us. Thank you to my wonderful panel for such a great discussion. And please feel free to check out our website and give us a call. Thank you.